You are listening to The Vocal Technologist. Spoken tech for your ears.
If you've been trying to keep up with the digital asset world lately, you know the feeling. The pace of change isn't just fast, it's fundamental.
It really is. We're seeing the core infrastructure, the stuff that defines how value moves and who owns what. It's all shifting at warp speed.
Right. And that means we have to kind of step back from the daily chatter, the market moves, and really analyze the structural changes that are happening underneath.
Exactly. What we're seeing is this graduation from technical experiments into essential world infrastructure. And that shift is what's really setting the stage for 2026.
Yet the last year was all about slow, measured institutional progress. The next one is being framed as the year of activation. So our mission today is to help you understand those tectonic plates moving beneath the surface. We're really trying to get at two major tensions that run through everything.
Okay, what are they?
First, that perpetual battle for control. How do you balance genuine decentralization with the speed you need to actually build competitive products?
The eternal question.
And second, that pivot from just pure speculation to real tangible utility. Are we finally seeing these assets become the plumbing for global payments, for settlement, for autonomous AI systems?
And these forces are, I think, what's ultimately pushing people away from the traditional financial system.
Exactly. So let's jump right into that first one, the battle for control, because there's some serious governance drama unfolding at Aave right now.
Oh, yeah. I mean, with over $33 billion in total value locked, this protocol is facing a full-blown identity crisis.
It's one of the most important token holder rights debates I think we've ever seen.
For sure.
The drama is just, it's incredible. The core of the dispute is about transferring brand control.
Right, the trademarks, the domains, the social media accounts, everything.
All of it. Moving it from the development team, Aave Labs, over to the DAO, which is, controlled by the token holders.
And the thing that kicked it all off was the CowW swap fees. Right.
That's it. The fees were flowing to Aave Labs instead of the DAO treasury. And that really brought this fight to a head. It's literally a fight over who owns the keys to the kingdom.
And here's where that tension you mentioned really comes into play. The argument from the lab supporters is, it's pretty stark.
What are they saying?
They're basically arguing that company autonomy is the only way to get competitive execution. They claim, and this is a direct quote, that DAOs are structurally incapable of the product velocity you need to ship quickly.
Wow. That's a direct shot at the entire philosophy of decentralization.
It is, but the DAO advocates, people like Mark Zeller, they have a really solid counterargument.
Which is?
It's a financial one. The token holders are the ones who bear all the economic risk. If the protocol succeeds or fails, it's on them.
So if they carry the risk, they should control the brand and the infrastructure. It makes sense.
It does. And if you look at the immediate impact, you can see why the whole space is watching so closely. The vote right now is 58% against the transfer.
But I saw that a huge number of voters are just abstaining.
A full 1/3. It signals a really deep division. And of course, the market reacted. The AAVE token fell 18% over the week.
And what was that about? A hostile takeover attempt?
Yeah, there were accusations flying because the proposal was timed over a holiday, and it involved this big wave of new delegations with a ton of voting power. The tension is palpable.
So if the labs team is right, if DAOs really are structurally incapable of moving fast, isn't that an existential threat to the whole idea?
That is the core tension, right? Is decentralization a regulatory shield, or is it just an operational handicap? It's a question the whole industry needs to resolve.
But what's interesting is that even while the governance models are, clearly straining, the financial mechanics underneath seem to be more resilient than a lot of people think.
That's a great pivot, because there's a really key insight about the economic moat that DeFi lending protocols have.
Right. The common idea is that the vaults and the curators, the user-facing tools, they own the distribution, so they'll capture all the value.
But that's not what's happening. We're finding that lending protocols, your Aalives, your Sparks, they often earn substantially more than the vaults built on top of them.
So the takeaway is, stop chasing the shiny upstream projects and focused on the plumbing.
Pretty much. Lending protocols skim a reserve factor on the interest paid on borrowed notional, and that borrowed amount is usually multiples of the TBL that the vaults are charging fees on.
So they're capturing this deep, consistent revenue stream that's actually more powerful.
Exactly. Their cut of the interest can rival or even beat the economics of major upstream issuers, like, say, staked ETH issuers. The lending infrastructure is where the real money is being made.
Okay, so while the protocols are fighting internally for control, the outside world is starting to engage. Let's look at how governments and real-world institutions are stepping in. And there's a really surprising example from Ghana.
Yeah, what's happening in Ghana is fascinating. They just passed the Virtual Asset Service Providers Bill.
So they're legalizing crypto trading.
They're legalizing it and requiring registration with their central bank or their SEC. So instead of fighting it, they're managing it and really embracing its utility.
And the activity level there is already huge, right?
It's massive. $3 billion in crypto transactions in 1 year. 17% of adults are already using crypto.
Wow.
But their plan for 2026 is what's really forward-looking. They're actively exploring gold-backed stablecoin.
We're gold-backed, okay. For what purpose?
Specifically for payments, trade finance, and FX settlement. They want to lower transaction costs and strengthen compliance. This isn't some theory. This is national infrastructure planning.
And you can contrast that proactive national strategy with what we're seeing in Western finance. The big giants are moving in, but they're keeping a very tight grip on control.
The JP Morgan example is perfect. They just launched JPM Coin, their tokenized deposits, on Coinbase's base blockchain.
Which is huge. But we need to make a distinction for everyone listening, right?
Yeah. Absolutely. JPM Coin is not a public stablecoin. It's a permissioned, whitelisted, tokenized deposit product. It's more like a cousin of stablecoins.
And it serves a need that regular stablecoins can't because of regulations like the Genius Act.
Right. That act limits how financial institutions can use stablecoins for things like collateral. JPM Coin sidesteps all of that because the bank keeps sole control over the smart contract.
But it's that trade-off again. They'll use public infrastructure, but only with centralized control.
And that institutional movement is getting a tailwind from regulatory maturation in the U.S. There's some proposed tax relief in Congress that really signals broad acceptance of stablecoins as a payment tool.
What's the biggest benefit there for, the average person?
The main thing is that they're finally treating crypto payments like cash. It removes a huge tax headache. The proposal would exempt stablecoin transactions under $200 from capital gains taxes.
So that's big.
And crucially, they also plan to defer income recognition on staking and mining rewards for up to 5 years. That directly addresses the phantom income issue, which has been a nightmare for so many people.
Okay, let's shift gears a bit to the technical frontier, because this is where things get really interesting. We're moving beyond AI and crypto just being about data sharing.
Right. We're moving into the realm of autonomous agents that manage their own assets and payments. It's like AI paying its own tolls.
That's a great way to put it. So we're talking about agentic payments.
Exactly. And the partnership between BrowserBase, Coinbase, and Buy402 Bazaar is a perfect illustration. The mechanism allows large language models to autonomously pay for services per browser session.
Using instant USDC settlement.
Yep. And it completely removes the need for a human to approve anything. No API keys, no complex billing.
So an AI agent could, navigate a live website, use a service, and just instantly pay for the compute it consumes, all by itself.
Precisely. Coinbase handles the settlement and custody on the back end. It unlocks these incredibly complex workflows where agents are just out there using the real web and paying their way in real time.
And the prediction is that someone like Cloudflare could become the gatekeeper for this non-human commerce.
Through the Buy402 standard, yeah. It's a fundamental shift.
And of course, a shift that big is going to have a huge impact on market mechanics and how people look for returns.
Oh, absolutely. The data is pretty clear that the era of easy, lazy yield is ending.
You mean the 20–30% returns from endless airdrops and perp incentives?
All of that. Those opportunities are compressing and fast because the market is just getting more mature and efficient.
So if that easy yield is gone, where's the next frontier for scalable yield generation?
The new path is embracing actual time-tested financial mechanics. We're talking about on-chain options selling.
Like covered calls and cash-secured puts.
Things like that. It's emerging as a highly scalable way to earn yield by explicitly warehousing volatility, instead of just hunting for temporary loopholes. You're shifting from hunting arbitrage to selling insurance.
That is exactly the kind of structural change we love to unpack. But, balance is key. If this technology is really graduating to become world infrastructure, we have to talk about the risks.
We do. And we should start with a big one. A technological threat that used to sound like science fiction, but it's now on a very real engineering timeline.
You're talking about the quantum threat.
We are. Quantum computing is no longer some remote theory. And given how famously slow Bitcoin's governance is, the network really needs to start preparing for a post-quantum world right now.
What's the specific danger here, beyond just, cracking keys?
The core threat is the existing supply. There are millions of Bitcoins sitting in old pay-to-public key outputs. We're talking about some of the original Satoshi-era coins.
And they can't be moved to quantum-resistant addresses.
They cannot be proactively migrated, so a quantum-capable attacker could just scoop them up or freeze them. It would force the entire community into a high-stakes, contentious fork decision under huge duress. Institutional confidence would just evaporate overnight.
That is terrifying. Okay, so from an existential tech risk, let's shift to the immediate operational risks. Because if this is going to be financial infrastructure, it has to handle compliance and it has to maintain trust.
And we have some very recent examples of failure on both fronts.
Let's start with compliance.
Binance. They processed $1.7 billion through suspicious accounts. And get this, $144 million of that was after their $4.3 billion settlement in November 2023.
After the settlement.
After, with links to sanctioned entities. And the material notes that their compliance team failed to detect physically impossible login patterns.
What do you mean by that?
Logins happening in different continents within minutes of each other. It's a fundamental operational failure at a critical choke point.
And on the community trust side, we're seeing a social model just completely fall apart with these creator coins.
Yeah, on platforms like Zora and Base, they're failing because the platforms are encouraging speculation over loyalty.
Right, they're framing them as investment opportunities, running trading contests.
Pushing these green-red categories, it just inevitably leads to pump and dump cycles. The early folks profit, later buyers get wrecked, and community trust is just... it's destroyed.
It seems like the intention just matters so much. The model that works is the one we see in Web 2, where fans spend money on merch or tips without expecting a profit.
Exactly. When you encourage speculation over loyalty, the model is just inherently fragile. It doesn't build anything lasting.
Which ties back into the idea that the market is demanding real utility now, not just financial engineering tricks.
That's the bottom line.
Absolutely.
Yeah.
So let's recap a bit. What have we tracked here? Governance models are straining under this pressure of speed versus decentralization. Real-world assets are being tokenized, and aggressively, by major financial giants. And AI agents are rewriting how payments work. It really does make 2026 look like a critical activation year.
And if you synthesize all of that, you see the financial landscape kind of splitting in two. You have stablecoins attacking cross-border corporate rails. You have AI unbundling asset manager workflows.
And prediction markets are having a breakout year.
A massive breakout year.
Yeah.
And they're being positioned by Wall Street not as gambling, but as price discovery mechanisms.
Which brings us back to where we started. Why is all this adoption happening right now at this scale?
Well, the thinking points to this emerging phenomenon of financial nihilism.
Explain that.
It's the idea that because of things like massive housing costs just breaking the traditional social contract, consumers are quietly abandoning belief in legacy planning. The old 60-40 retirement portfolio. It doesn't feel real to a lot of people anymore.
And this breakdown is fueling the adoption of open finance and alternative assets.
It seems to be a major driver. So the provocative thought for you to take away is this. What does it mean when Wall Street is making these huge strategic bets on things like prediction markets, a historically decentralized concept, at the exact same moment the average person is losing faith in centralized financial planning? The ground is definitely shifting under everyone's feet.
Spoken Tech. For your ears.